What's up everyone, it's Caddy with Money Vesting. So in this video, I'm going to be sharing one of these spreadsheets that I've made available for you to download. So what we're going to go over is the entire balance sheet and financial health of a company. So I'm going to go over every single metric that I personally look for, and hopefully this will save you a ton of money when you're analyzing and investing in companies on your own. And my gift to you is going to be that this spreadsheet is available for everyone to download on our Patreon. Doesn't matter if you are a member or not. I've made it open to the entire public, so you can download this spreadsheet from our Patreon. All I ask in return is that you hit the like button and of course subscribe to the channel if you haven't already. I would really appreciate it. So I've seen, a lot of companies out there, unfortunately, that don't necessarily have, the best balance sheet out there, or may not be in the best financial health or the financial state here. And that's exactly the whole point of this video, right? I want to help you understand some of the metrics when it comes to the balance sheet, and this will quickly help you analyze which companies are good versus which companies are not so good when it comes to the balance sheet alone. And when you get a good understanding of the balance sheet in itself, you will also have a very good understanding of whether this company has a high risk of bankruptcy versus a low risk of bankruptcy for that company. So we're going to do a live analysis of Apple. I'm going to run through the spreadsheet. I'm going to go over what those input fields are and what the output's going to look like and what are some of the metrics that we really look for. I'm going to explain all of that. So this will be a bit of an educational video for all of you. So hopefully it doesn't get too boring. But as I said earlier, make sure that you drop a like and of course subscribe to the channel if you're just joining us for the first time. And I'll also be sharing the link of where you can download it. I've made it available on our Patreon. So again, that's just my gift to you. This right here is going to be, again, the balance sheet spreadsheet available. And you can literally just click on that PDF and it's going to be an Excel spreadsheet. You can download it for free, no strings attached. All I'm asking is that you keep watching and of course keep supporting the channel with your views. I really appreciate all of you. So this right here is going to be the balance sheet structure. So what we have over here is a very simple. I wanted to keep it as simple as possible for everyone to be able to understand and analyze and use it on your own, right? So I'm not going to be around every time answering questions. I want you to be self-sufficient eventually and be able to analyze companies and really understand what these things actually mean. So we're not going to go into too much detail, like in terms of like all these things. Like if we don't have the time to go into too much detail, on what free cash flows are or long-term debt is, what, inventory levels are, EBITDA is. I'm not going to dive too much into it, but where we're going to focus is all of the over here. These are the 9 metrics of the balance sheet that I like to pay attention to when I'm analyzing a company. And if I can, find companies that have excellent financial health with these 9 metrics, chances are I'm definitely going to be doing more analysis on that company in terms of growth and profitability and, the product itself, the services, and some of the other things, right? So this is only one of the 3 financial statements. So obviously I don't want you to think of this as like, this is your only analysis. No, this is one of the most important type of analysis, which is looking at the balance sheet. But of course, you also have to pay attention to valuations and revenues and earnings. Is the company even growing? Because you may have a company that has a great balance sheet, but if it's not growing, well, the stock price is not going to perform. So what this is simply quickly analyzing the balance sheet of any company you want. And then you can do some additional analysis and research on that company moving forward, and do some extensive research on the product and the service that they're selling, the growth, the management, the valuation, the technical charts, all that stuff also happens. So got to keep that in mind. So today what we're going to do is we're going to quickly analyze Apple. I'm going to share some of the things here, and these are the 9 metrics as I mentioned earlier. So first things first, all we have to really do is input all these numbers in. So once you download the spreadsheet, what you're going to see is you're going to see a little bit of a disclaimer at the first. That's going to be your first front page. And then of course you've got the balance sheet metrics over here. So you've got input fields all over here. We've got a total of, let me just take a quick look. We've got a total of 13 input fields, and you're going to find all this information simply from the company's income statement, balance sheet, and the cash flow statement. So what I've done is I've simply gone over to Seeking Alpha, and I'm going to type in AAPL. That's going to be Apple. And once you're on Apple, all we're going to do is we're going to go to the financials, and starting with income statement, we're going to start plugging in some of the numbers in the input fields. So for example, one of the things that is required for this analysis is EBITDA, right? So EBITDA, again, earnings before interest, taxes, depreciation, and amortization. Not going to go into too much detail, but where you can find EBITDA all the way down here, you can scroll, you can find EBITDA here, and we're going to take the trailing 12 months at 125 billion. So 125,288, we're going to plug that number in over here. Done. That's your first metric done. We're going to fast forward and of course do all of these together. So let's just come over to operating income. That's going to be 113,965. 113,965. We've got the net income, which is going to be your actual profitability. You're going to scroll a little bit down and you're going to find net income over here. That's the actual profit of the business. Trailing 12 months, 95,171. So you got 95,171. And then we got interest expense. That is going to be how much the company is paying on interest every single year on the debt that they actually have. This is going to be part of the income statement as well, right? So that's the only place you're going to find it. You're also going to find it in the cash flow statement, but interest expense, it's how much interest expense the company's paying on their debt, right? Should be self-explanatory. Now, Apple's a little bit of an anomaly. Not every company is though, because Apple has so much cash on the balance sheet. That's why they pretty much earn interest on the cash as opposed to interest paid on the debt. So they actually receive a net credit every single year as opposed to payments paid to their creditors. So they're definitely smart about that, right? So interest expense, you can see it's a negative number, 3240, which is why the company is actually earning interest as opposed to paying it on their debt. So they're very, very flooded with cash, and that's one of the reasons why they're able to make money. So we're going to plug that number in, negative 3240. So that's going to be it. And when it comes to that's going to be it. That's going to be it for the income statement. Now we're going to move on to the balance sheet. And under balance sheet, we got to really account for a lot of things here. So the first things first, what we're going to do is we're going to take into account inventory levels. So inventory is going to be over here. And you'll notice that inventory right now for Apple is 6820. So in other words, they're sitting on $6.8 billion of inventory. So we're going to plug that number in, 6820. We're going to plug in current assets. So all current assets for the company, which is going to be right over here. So current assets, total current assets sitting right here, 128,777. So we're going to plug that number in, 128,777. Current liabilities. So again, you scroll down a little bit and you've got your current liabilities over here. Total current liabilities for Apple, 137,286. So 137,286. Again, it's just a process of you just plugging these numbers into this spreadsheet. Once you've plugged those numbers in, then we're going to talk a little bit about these ratios, what they mean, what's the preferred metric, and how to go about analyzing it. Then we're going to talk about long-term debt. So how much in long-term debt the company has. We're going to come down to long-term liabilities, and over here, long-term debt sitting at $99.6 billion for the business. We're going to plug that number in, 99,627, I think is the number. Perfect. And then if we come over here, we're going to also account for cash and marketable securities, right? So cash and short-term, long-term investments, that's how much liquid cash the company has. Doesn't matter if it's maturing in under a year or over a year, it's cash on the balance sheet. So for Apple, you'll notice that total cash and short-term investments are sitting at 51.3 billion, but then we also have long-term assets, long-term cash or marketable securities for the company, which is going to be sitting right here, long-term investments at $114 billion. Pretty much that's the amount that's generating a lot of interest for the company every single year, right? So you see that interest expense as a negative number, meaning the company is actually earning interest. That's the number that it's coming off of, right? It could be a CD, it could be a government bond, whatever it is, it's earning interest for the company. $114 billion. So we pretty much are going to take that sum, 114.095, and 51.355. So we're going to plug those numbers in. So that is going to be under cash and investments, 51, and that was 355, plus 114.095, and that's going to be a total of $165 billion for the company is how much cash and short-term and long-term investments the company has. Total assets is going to be over here. Again, very simple, very basic stuff. Come down here, pick up total assets, 346, 747. It's 346, 747. And we got total liabilities sitting all the way down here. Total liabilities, 290,020. 290,020. And last but not least, now we're going to jump over to the cash flow statement, and we're going to find out the free cash flow and the depreciation expense. So once again, we're going to come over here, free cash flow. Under the cash flow statement, scroll all the way at the bottom. You've got your levered and unlevered free cash flow. Doesn't matter which one you pick. I'm going to go over that in a separate video. We don't have the time too much, but 84,729. and that's going to be plugged in over here, 84,729. I'm taking the trailing 12-month numbers because that's the last 12 months. And then for the balance sheet, you're going to get like a snapshot, right? The balance sheet is not like trailing 12 months or whatnot. The balance sheet is more like a snapshot of the most recent quarter, but income statement and cash flow is on a more trailing 12-month basis. And then finally, we got depreciation expense, which you are going to again come up a little bit here. We got depreciation and amortization of $11.3 billion trailing 12 months basis, 11,323. We're going to plug that number in. Perfect. So now you've got all of your input fields done, and now everything will be calculated automatically. You don't have to do anything else. All you have to do is just pretty much plug in all these input fields, and the spreadsheet will take care of the rest. The first thing it'll be calculating is net debt. Net debt is simply your cash minus debt. If the company has more cash than debt, or in other words, it's debt minus cash. If the company has more cash than debt, this number will be negative, and we want this number to be negative. We've always wanted this number to be negative because we want more cash than debt on the balance sheet. If this number is positive, then of course the company is more debt than cash. The formula for net debt is debt minus cash. So now we move over to some of these metrics, and these are the ones that are really, really important. And what this really means is, let's just go over it one by one. So for Apple, and these are color coded, by the way. So for current ratio, you'll notice that we are red. Quick ratio, we are also red. Everything else, we are green. And these are the preferred metrics, right? So this is what I really want to see when I'm analyzing a company's balance sheet. I want to see over 1 current ratio. That's why it is red, because Apple has 0.94. Quick ratio, I also want to see above 1. Right now it's 0.89, hence it is red. Debt to free cash flow, I want to see under 3. And right now it's at 1.18, so it's green, so on and so forth. You can see that most of them are green. Even this one is or should be green. I haven't coded that yet. But what we're looking for is this number to be a little bit over 5. But the reason why this is negative is because, well, the company Apple is generating interest as an income as opposed to an expense, right? So they are actually making money through interest as opposed to paying it to creditors. That's a good thing. So let's talk about current ratio. Current ratio is nothing but current assets over current liabilities, right? So it calculates your short-term liquidity for the business. So that's why we want this number to be over 1, because I want you guys to think about it in terms of logic, right? Do we want a company to have more current assets than its current liabilities, or less current assets than its current liabilities? Of course, the first one, right? We want the company to have more current assets than its current liabilities, right? That's why we want this number to be over 1, and that would mean the company has more current assets than current liabilities. Apple, unfortunately, it's struggling a little bit. When you talk about quick ratio, all you're really doing is the same thing. You're taking current assets over current liabilities, but you're taking out inventory. You're excluding for inventory, right? So you're really looking into the actual short-term assets versus short-term liabilities, but not taking into account inventory. Oftentimes, you will find companies that may have a very high current ratio, let's say 3, 4, but when you look at their quick ratio, it might be like 0.5 or 0.6. Why? Because they've got a lot of inventory sitting on the balance sheet, right? If their inventory is not selling, yes, it's part of an asset, but if you look at the real picture, if you look at the quick ratio, when you exclude for inventory, their balance sheet's not that great. Their short-term liquidity is not that great. That's why we want both of these numbers at over 1. For Apple, unfortunately, it is a little bit under 1. It's not immediately a red flag, right? So it's not like, yay, current ratio is less than 1, I'm not investing in it. No, you have to obviously do more research. You have to understand the reasoning behind why that's the case. And of course, you have to look at some of the other things as well, right? Revenue, earnings, the company itself, the valuation, the technicals. We're not going to go over those things, but I'm just saying, like, if anything's under 1, if anything's red coded, doesn't automatically make it a bad investment. It just means that you have to look into it more. You have to do more research on that particular metric and see what's going on. Now, when it comes to debt to free cash flow, so this metric pretty much helps us understand how long in years will it take for a company to pay down its debt simply by using free cash flow. Okay. So we want this number under 3, meaning that we want companies to be able to pay down their free cash flow, pay down their debt using their free cash flow in under 3 years. So that's why for Apple, it's at 1.18. Not a problem. We got plenty of cash flows coming in, and the debt is also reasonable. So huge check mark and a green color for that. Total assets over long-term debt. Again, think about it logically, right? What does that actually signify? That simply means how much total assets the company has with respect to its long-term debt. And we want this number to be above 1, right? Obviously, we want the company to have more total assets than long-term debt. And for Apple, it's sitting at 3.48. Not a problem there. Huge green color coded. Perfect. Way to go. Now, when it comes to net debt over EBITDA, so net debt, as we calculated earlier, is simply debt minus cash, right? So if this number is negative, right? If this is negative, then we can skip past net debt over EBITDA. It's not going to matter. Why? Because the company has more cash than debt on the balance sheet to begin with. So we don't really need to focus on EBITDA. Ideally, if the company had a positive net debt, meaning more debt than cash on the balance sheet, then we really need to understand that, okay, if all the cash was exhausted in paying off the debt, whatever leftover debt is left, right? Whatever leftover debt there is, how many years will it take for EBITDA, which is earnings before interest and taxes and depreciation? How many years will it take for EBITDA to pay that off, right? Pay off the leftover debt. That's the analysis when we look at net debt to EBITDA. Okay, but if this number is negative, net debt is negative, then we can skip past it. Right now it's negative 0.53, but similar to debt to free cash flow, we want this number to also be under 3 because we want the companies to be able to pay off their debt, net debt, using EBITDA in under 3 years. Next up, we come over to cash to debts. Again, a very self-explanatory, very logical metric. We're looking at cash on the balance sheet versus debt on the balance sheet, and I want this number to be above 1. Very, very rare situations you'll find this number over 1. I can tell you, like, very rare the company will have negative net debts, and if they do, that's a phenomenal business in terms of the balance sheet. Most of tech companies will have more cash than debt, but then also depends, the type of company that you're looking at. If you're looking at utility companies, materials, industrials, I mean, those are very capital intensive businesses, right? So they do require a lot of infrastructure, a lot of CapEx. So my assumption going into those analysis is that, okay, they're probably going to have a higher debt. So I can't strictly be looking at cash to debt because chances are they're going to have more debt than cash. So then I do lean a little bit more towards debt to free cash flow, net debt to EBITDA. Like, are they able to generate significant amount of free cash flow and EBITDA to pay down their debt in under 3 years? And then I also lean a little bit more towards total assets and long-term debt, total assets and total liabilities, which is the next one. Again, very self-explanatory, very logical scenario that goes over, how much assets the company has with respect to its total liabilities. And we want this number to be above 1 as well, green coded. This right here is going to be their interest coverage ratio. This is another metric that I really like to focus on. And what this does is that it helps us understand, does the company actually have enough operating income coming in order to pay down their interest expense, not interest on, not debt, not the total principal debt, but the interest that they're charged per year. Okay, that's the interest coverage ratio. We want this number to be above 5. And the simple premise or the simple analysis behind this is that we want the company to be able to generate profitability, enough profitability to pay off its interest expense, right? The interest on its debt. Because if the company is not even able to pay the interest on the debt, how can you expect the company to pay down the debt on its debt, which is the principal? So interest coverage ratio, super important metric. And again, I lean a little bit more towards these metrics, not so much on the cash to debt. If the company that I'm analyzing belongs to like an industrial or materials or higher CapEx type business model, if it's not a tech or a software company, you definitely expect higher, debt levels for those companies. So that's something to keep in mind. You might find a lot of red coatings there if you're looking at industrials or materials companies. So you definitely want to keep that in mind. That it doesn't necessarily make that a bad company altogether. But yes, the balance sheet definitely needs improvement for those companies. And then last but not least, we got a solvency ratio, which pretty much tells us a little bit about how much in net income the company is generating in order to pay off its all liabilities, not just debt, but all of its liabilities. The higher the number, the better it is. That means the company is generating a lot of profitability, a lot of net income. So the formula for this is net income, and you add back the non-cash expense, which is depreciation and amortization, and then you divide that by total liabilities, and you get that 36.7% in the case of Apple, and we want this number to be above 20%. So that's the entire spreadsheet. All you're really doing is plugging in your input fields, which are 13 of them, by going over the income statement, balance sheet, and cash flow. Everything else will be calculated on its own. And I just want to be very clear that just because something is red doesn't necessarily mean that it's bad, right? It just means that it needs your attention, right? That's the difference, right? Just because it's red doesn't mean that you're kind of completely ignoring that company altogether, but it just means that it needs your attention. And you need to do more research on that. So for example, if I were to look at Apple like 0.94, which is red, right? So I would go into the balance sheet and I would look at, okay, what's actually going on? The company does have a lot of short-term assets and cash. Then they're sitting on accounts receivable at $23.7 billion. And we've got other receivables at $30.4 billion, $54 billion in receivables. So company definitely has a lot of incoming cash flow in the future because they are selling their product on credit. And then inventory, $6.8 billion. We got other current assets sitting at $16.4 billion. So total current assets, $128 billion. And if you come over to their current liabilities, we got accounts payable, $59 billion. We got short-term borrowings, $1.7 billion. And current portion of their long-term debt. Okay, so there you go. So $9.7 billion is going to be their current portion of their long-term debt. What does that mean? That means that the long-term debt they have, $9.7 billion is going to be maturing in under 1 year. So they need to pay that off. And after this year, once this one is paid off, we can literally reduce the current liabilities by about $9 billion. So what is 137 minus 9? And that's going to be 128. So now we'll have current assets equivalent to current liabilities, sitting at current ratio over 1. Right? So those are the type of analysis that you need to understand and do, and kind of really have a good understanding. Okay, just because it's red doesn't mean it's bad. It means that it needs your attention to do more research on why it's red and what's going on with that company. So hope you guys enjoyed this video and a complete update on this balance sheet spreadsheet. I'm definitely, hoping that it saves you a lot of time and a lot of money when you are analyzing companies. And again, balance sheet is kind of like the backbone of a company. And even Peter Lynch, has mentioned that before, that if the balance sheet's great of any company, it's not going to go bankrupt, right? I mean, the bankruptcy risk is just so low if the company has a phenomenal balance sheet, right? Think about a company that has literally no debt, plenty of cash, plenty of assets. The probability of that company going bankrupt is zero, next to nothing, right? I mean, it could get acquired, it could still come down, the stock price could still come down, but it would never go bankrupt because it doesn't have any creditors, right? It doesn't owe anything to anyone. So very, very helpful analysis, in my opinion. Just let me know your thoughts down in the comment section below. You can always download it. I will share the link down in the description below. As always, happy investing, and I'll see you all in the next video.